Good evening, everyone. Welcome to our special edition of Astor's Glassdoor portfolio review. So we're really happy to have you here today. It's going to be a very, very unique Zoom that we've been working really hard on. For those of you joining for the first time, I'm Marika Dzhindzhikhashvili, Chief Operating Officer of Astor Realty Capital, and I'll be co-hosting tonight's session alongside with our CEO and founder, Joe Berko. So let me begin with an introduction to who's Astor. Astor Realty Capital is an institutionally backed private equity firm. We focus on real estate investments. Our offices are in Manhattan and Miami. We specialize in value add and ground up development projects across major US markets, and we currently manage a portfolio of 3.3 billion real estate assets across more than 4.7 million square feet of commercial and multifamily development. We're proud to consistently deliver returns to surpass industry standards on average, which is direct reflection of our discipline, underwriting, experience, leadership, and active portfolio management. Our mission is simple, yet powerful. Astor Realty Capital, we believe in breaking traditional boundaries by leveraging our collective bargaining power, and we're dedicating to leading our community of investors towards financial security, growth, integrity, authenticity, and transparency. For us, it's not just business, it's personal. Now, let me introduce the co-host, the visionary behind Astor's success, Joe Berko. Joe is a highly respected entrepreneur with over 25 years of experience in commercial real estate. He founded Astor with the goal of creating an investor-focused platform that combines creativity, structure, and results. Under Joe's leadership, Astor has participated in more than 26 ventures across 12 markets and contributed over 3.6 million square feet of prime real estate development. Joe's work has earned national recognition, including titles of Power Broker, CoStar, New York Signature Broker, and Globe Street. So let me get started. I'll welcome Joe to the floor, and we'll also let you know what we have ahead of us and introduce our two guest speakers.
Wonderful. Thank you, Marika. Thank you all for joining us this afternoon. I know we've been having a bunch of glass doors back to back to back, the difference between having Laura around and not having her around. But I am happy to have a very different conversation today. So really the focus is not only how much you make, but also how much of that you actually retain. And now we're referring to the post-tax impact. Right, so we have a couple of strategies here that we're going to be exploring together. Well, actually, there's three strategies. The first one is, in fact, a no strategy. You make money, invest with us, invest somewhere else, invest in capital markets, and you pay your taxes. Then you have other strategies, right? IRAs. What is that about? How much can you put aside? What's the impact investing through an IRA versus not? And then finally, we also have Adam Ausloos, who's an expert in making sure that your structured is such that you can defer taxes further down. We're going to be exploring all of it, and hopefully some of those opportunities and some of those structures will hit home and will help you make some decisions. And so without further ado, if you can put up the presentation, please. Okay, very great. Thank you for that. So for those that are new here, just a snapshot, I think a snapshot of our activity. As of second quarter of 2025, the collective experience of both myself, Alex, Marika, Laura, other members that you know and fond of and that have joined the company is around 65 years. Myself, 30 years at this point, started in the business in 1995, and this year marks my 30th year in this industry. We are investing in 12 top performing US markets, which makes this company a national company, a national firm. And when we say top performing markets, there's a list, and every year it changes a little bit. Sometimes it stays static, but those are markets that are showing strong growth, markets that have seen very, very positive migration and are showing us very great growth in terms of job creations and demand for jobs. We also look for those markets within the top 25 with a specific age group of around 38 years old. To date, we've actually participated in 38 projects and exited to date 16. I expect that by the end of the year, this number will shroom up to 20 projects. But of course, we're onboarding additional ones. Mark to market, Astor's portfolio in overall participation surpasses $3 billion. And if you look at the amount of capital that we've raised, which is somewhere in the $167 million range, mark to market, including profits, it's about $283 million. A lot of what we do is ground up projects. We love ground up. We understand it. And our philosophy is only do it with best in class operators with many, many years of experience. So in terms of square footage, on that matrix, we're looking at around 4.7 million square feet. Across all strategies combined, we're looking at 22.3%, and that includes debt position, structured debt, preferred equity positions, which are very popular because they pay on a quarterly basis and they show dividends along the way. And of course, our equity positions, which obviously are much higher, but if you average all of them combined, we're looking at 22.3% Astor level return. Just to give you sort of like a breakdown on structured debt, we have done 6 different projects from inception, not a lot of capital, just shy of $4 million, and are generating around 16.7. Structured debt as those positions where we take a first position and bifurcate it, leverage it out, create a mezzanine position, or simply go as a first position lender. So 16.7, again, Astor level gross returns. Preferred equity, which is 14 positions out of 38. Essentially, we've invested over $87 million and generated on average 19% return. Preferred equity, for those who may not be familiar with the term, is essentially sandwiched between the debt and the actual common equity, where we take a preferential treatment. Usually comes with a coupon that is fixed, sometimes a little bit of a kicker to entice things, but essentially reduces the risk and allows us to generate nice returns and a gorgeous cash flow to our investors. Lastly, the joint venture equity, which are very popular as well. 18 different projects, $76.5 million invested, generating an additional $72 million in profits and a nice 26.6% return average, 26.6% return average. But if you put everything combined, sort of like mix it up like a nice little salad, you're looking at 22.3% annual return across all strategies combined. A nice portfolio is spread over 7 different states, between Phoenix, Dallas, Florida, various cities in Florida, Columbus, Ohio, New Jersey, and various cities across New York, as well as Chicago, Illinois. Before we'll go and dive into the conversation, we do have 2 great experts that we've been working with over the years. They've also been very instrumental in referring a lot of their clients over to us because as they sit on capital and they manage this capital, they look for managers like ourselves and look for those opportunities. And so our projects have been very, very popular with them. We created 2 simple examples, and I hope that those of you who are watching this can actually see those 2 examples. Left side, we have a taxable account. Right side, we have an IRA account. We're trying to understand sort of like the difference and the impact of a certain amount of dollars invested today under both of those strategies. Strategy number 1 on the left side, taxable account, is what if you invested $300,000 year 1 and you generated around a 15% return. Okay, so an average of 15% return. And assume that every 4 years, your project came back, made you some profits, and then you reinvested again the projects along the dividends, and then done that on a consistent basis for a course of 20 years straight. All right. So in the left side, we can see the $300,000, including principal, will generate for you on a 15% consistent basis, $2.1 million. 300,000 invested, including principal, $2.1 million. After tax impact is around 1,830,000. And so you've generated around those amounts. Again, this is including the principal. The IRA account, on the other hand, 300,000 invested, is deferring the taxes. So instead of paying taxes on a consistent basis, you're in fact deferring the taxes and pushing a larger amount. So we can see it here. Look at year 5, okay, which is 4-year investment. And then beginning of year 5, we've invested $444,000 on a taxable account. That's what we have available because we've paid the taxes along the way, versus not paying taxes, which basically grew your $300,000 to $480,000 principal included. If you were consistent and you were taking this amount of money and reinvesting it, okay, 4 years into it, $657,000, right side IRA account, $768,000. And so the story continues 4 years into it, 972 versus 1.228, ultimately 1,439 versus 1,966, almost $2 million. And ultimately, we're looking at 2,130,000 taxable versus 3,145,000. Okay. Now, profits will be the after-tax growth. And so the difference between both columns, left side, right side, we have 1,830,000 versus 2,845,000. So it's quite an impact. Okay. It's a unique example to really sort of like give you the understanding of what does it look like, to sort of like not pay the taxes and defer them along the way. More capital is working for you, more capital is generating income. And so ultimately, to differentiate between the two, we have an after-tax growth versus the after-tax growth between both positions. 1,830,000 versus 2,272,000. And I'm referring to this number, I'll spend a moment on it. Ultimately, in this presentation, we haven't gotten too fancy, but in this presentation, essentially, when you break your IRA, when you break your saving account that you've sort of like grew without paying taxes, deferring the taxes, the assumption here is that you took the account and you've taken 100% of the capital out in day one. Now, that's not realistic. That will not happen, right? If you have so much money in your account, then you probably take chunks of it, small portion, and of course, you'll pay the tax on that. But for this illustration purposes, stay with us. We're looking at around 2,845,000. And here comes Uncle Sam and wants to get his cut. He wants to get his share. Uncle Sam says, listen, you've done great. You've been saving for 20 years. Now pay me my share. And so 20%, okay, we're talking about long-term capital growth. Long-term gains, 20% market share. We're left with 2 million as a net after tax, $2,276,000, or if you will, a difference of $446,000. And so with this illustration, I want to take it back to Marika and introduce our two guests to talk a little bit about different strategies and what do they think, and they'll go more into details about the mechanics of things, how to do, what to do, and most importantly, what not to do.
I love that, the breakdown. I think it's very important for everybody to really understand that, and just visually seeing that helps to understand how important it is to be able to function and have the right advisors, have the right people by your side that can show you ways of, with the tax implications, especially because we work with so many investors, being investors ourselves, to be able to make high returns, but also make sure that you preserve that capital is extremely imperative. So we'll start with Adam. And Adam, welcome. Thank you for joining us. Adam brings over 20 years of experience across banking, financial services, insurance, real estate, and definitely wealth building. He's a licensed fiduciary, CRPC, and owns an independent RIA with a team that includes some of the top 40 tax planning CPAs in the US. His expertise has been featured in national publications like Investor Place, the Miami Herald, International Business Times, Star Tribune, and Mercury News. He's appreciated on major networks like Fox, CBS, NBC, and ABC. So welcome, Adam. Thank you. I'll let you take it away.
Yeah, absolutely. Thanks for having me again. Joe and Marika, I always enjoy joining your calls and just helping kind of spread a little bit of knowledge and information to all of your participants. So yeah, my background is pretty diverse. As a licensed fiduciary advisor, as an advanced tax planner, specialist in high-level insurance programs. I'm even a fund manager of my own fund. I wear a lot of different hats, but at the highest levels of really what is available in all things finance. But my approach for years, for decades, has always been to look at things from a tax perspective first. How do we put structures in place to become more tax efficient in everything that you do? Right. So it's great that Joe and Marika are one of the private placement providers that I refer a lot of my investing clients to, just because I can trust their processes. They always produce. I have never seen them miss a payment. They deliver what is promised and what's presented, and most of the time they actually over deliver, which is great. So that for me as an investment professional, I feel very secure in referring clients to participate in their offerings. And that's great. They produce an amazing return. So it's fun to make money, but it's even more fun to keep all the money. So that's where I come into play. And putting the structures in place for my clients, a lot of them really do it one of two ways. They utilize some very unique specialized estate trusts that have a tax deferral treatment, and their trust actually is the investor into Astor Capital type investments or other private placements. I am a pretty unique advisor. I really only offer private placements, and then I team up with another broker dealer out of New York that does the market type investments, your standard, stocks, bonds, mutual funds. So most of my clients are making significant better returns using private placements. And they're looking for tax advantages, right? If you're making 15, 20% type returns, the tax planning part of it is even more important than if you're making smaller returns that are typical in the markets. So like I said, it's either the trusts are actually the investors into these private placement offerings, or people can use LLCs as kind of a secondary option. And then I can apply other tax solutions to LLCs that would mitigate or offset capital gains. So those are just two of the different structures that I typically help people with and recommend that they invest as opposed to investing personally. And if those two structures aren't the right fit, then the go-to that anybody has access to would be like a self-directed Roth IRA would probably be the other, third type of structure that would make the investment more tax efficient.
Wonderful. Thank you, Adam.
Before we'll dive deeper, since Adam, since you've mentioned the RIA and Tony, let me just do a quick intro for Tony as well, and then we can go further into some specific questions. We also have some questions that were sent to us by some of our investors that we would like to discuss and address. And of course, we want to also simplify everything that we're discussing here and be able to have everybody relate, and definitely encourage all our audience to come in and jump in and ask questions and put it in the chat as well so we can address that for you. So Tony, and thank you, Adam, for the intro. Welcome, Tony, from Entrust Group. So basically, Entrust Group has over 40 years of experience in alternative investment space with $4 billion in assets under management. And they're empowered thousands of investors to build wealth using different retirement accounts to invest in real estate and private equity and other tax-deferred or tax-free products. And Tony will walk us through how IRAs can be one of the most underutilized yet powerful tools in real estate investing, and how to use them to structure deals with efficiency, compliance, very important, and maximum long-term gain. So both Tony and Adam will be available for live Q&As towards the end or in between. And I'll give Tony some space to also give a better introduction. Thank you.
Thank you very much, Marika and Joe, for having me. Happy to be here. To dive deeper into a little background about Entrust, we are in our 43rd year of business. We solely are administrators and record keepers of self-directed IRAs. We provide these accounts to our clients that want to look to diversify outside your traditional stocks, bonds, and mutual funds to go into the private markets. Me personally, I'm on my 8th year with Entrust. Prior to that, I spent 10 years in the 401k space, and I really pride myself on retirement accounts and educating and assisting people in diversifying their portfolios. Majority of our clients do hold some form of real estate in a self-directed IRA. I would say probably 80% of all assets held in IRAs, self-directed IRAs across the country have some form of real estate. It is a great way to invest in real estate. It's a great way to invest in any private investment. And as many have said, making money is great, but being able to retain and keep most, if not all of that money, having a tax advantage way of doing that is the way to go. And we're happy to dive deeper into the different types of IRAs and the different tax classes that those IRAs have as we get further along in the presentation.
Thank you, Tony. So let's get started with basically how we can work with our investors, and what would be some of the first things, like when a client will come to you, what would be the first most important things to address?
Absolutely. Whenever speaking to any potential prospect, first question I always ask is, do you have an existing retirement account? Now, there's 3 ways to fund a self-directed IRA. First way is via contribution, maximum $7,000 per year, $8,000 if you're 50 and older. Not much you can do with that just starting off. So the 2 better ways of doing it, one is transferring an existing IRA from a brokerage firm into a self-directed IRA. You can either do a full transfer, move the entire account to self-directed, or you can do a partial transfer. Something that you've built up over the years allows you to completely diversify. On average, somebody changes jobs 12 times in a year, 12 times in their career. Over that time, you're leaving 401ks behind. All of those older 401ks can all be rolled over into a specific IRA, whether that's a traditional or a Roth, which allows you to get to those balances that you'll be able to make these level of investments. So really the first thing I speak to somebody about is, where are your source of funds coming from? And then we gear their strategy accordingly.
I want to ask you something, Tony.
Sure.
So that's the maximum that you've mentioned, 7,000, or if you're over the age of 50, 8,000, which again, it's a respectable amount, but not a great amount.
Sure.
But there's other ways, right? I mean, in my IRAs, I'm able to contribute significantly larger, I think over 60,000 a year.
Correct. So depending on the type of accounts have different contribution limits.
Mm-hmm.
2 most common accounts we see are traditional IRAs and Roth IRAs. You can now extend out to a SEP IRA, which gives you that, I think we're up to 70,000 this year. And then there's a simple IRA as well. I believe around 19.5 for that.
So who qualifies for a SEP IRA?
It's a simple employer plan with anybody with less than 100 participants in the company. Or you have a solo or individual 401k, which is for a business owner and their spouse.
Mm-hmm. Okay.
So there's many accounts that you can self-direct.
So
all
yeah,
the
there's different
types.
options. So if you run a business, own a business, then you can obviously contribute. Now you're saying up to $70,000 as opposed to maybe $7,000 or $8,000, correct? That's the impact right now?
That is correct.
Mm-hmm. Okay,
So
great.
for the 2025 tax year on the SEP, you're at 70,000. Or the lesser of 25% of your compensation, whichever's less.
I see. Okay.
Can we call, so we have Sandri. Sandri, you wanna jump on real quick for that question that you had? The question was, are there any ways to avoid UBIT taxes for self-directed IRA investments to leverage real estate investments?
Unfortunately, no.
Okay, perfect, thank you.
Can we go into what's the UB tax and what falls under that category and what's out of it?
Sure, I can go briefly into that. It's unrelated business income tax. Perhaps Adam can jump a little further into it, is more qualified to speak on taxation.
Mm-hmm. Adam, you want to take it? Are you familiar with UBIT?
I mean,
If
I
you're not,
am.
it's okay. What?
I'm I'm more the structural planner. That's actually more of a CPA question
Correct.
of how to address that.
Okay.
So my structures do handle that a little bit differently than IRAs
Mhm.
when you're talking about trusts and then doing tax structures and strategies at the
Mhm.
LLC level. So that can affect, how that tax treatment is reported on returns.
Yeah. So I want to clarify the questions about UBIT for Sandro, and thank you for asking that. So essentially, UBIT tax will apply if you're investing in a business, in buying a business and generating income out of that business. Okay, actively being in that business, generating income in that business, UBIT tax will be applied. To diversify the conversation or to get it more focused into our conversation, I'm going to pull it towards what we're doing here at Astor. Our investors are not subject to UB tax, right? So essentially, they invest passive as passive investors. We're the company, we're actually putting the capital to work for them. There's a third party that actually build the project. And so none of us are actively involved. Not in our case, so obviously we're actively involved, but none of our investors are actively involved to the extent that their IRA, I'm sorry, will be subject to UB tax. Those questions shows up every now and then, a couple of times a year. We get this question, and we always go and we check rulings and we check to see if there's any changes about it. But to be very, very clear, when you invest in a group like Astor, you invest as a passive investor. You're not actively getting into a business. You're in fact bringing capital into an investment where somebody else is the active participant. And so you're not subject to the UB tax.
So here's another,
Yeah, another question from Mark Sirota.
yeah, Mark, you wanna just jump in? Want to make this interactive? You don't have to be on camera, anyone, if you don't want to be.
Give me 1 second. I'll just be allowing Maya to talk, and Maya will pop up letting you unmute yourself.
Okay, so Maya Janelle is asking a question. I was told that while active employee, I can only roll over funds from 401 and not from 457 until retirement. So 401k, right? We're not 457, not familiar with that account, until retirement. Is that correct?
Not necessarily. So if you're an active employee with an active 401k plan, and that plan has a provision in its plan document that allows for an in-service rollover or an in-service distribution, usually available to participants age 50 and older, you may be able to roll a portion of that current 401k into a self-directed IRA. Not many plans out there have them, but it doesn't hurt to ask your employer if that provision is within the plan document. If you have access to your plan documents through your 401k portal, it'll be in your summary plan description as clear as day. And not just till retirement, even on the 457 plan, any separation from employment. If you leave that job and you go to another job, you're able to take that entire plan over.
Okay, thank you for that, Tony.
Wasn't able to unmute himself. He said he wasn't able to see it, but the question was, if you use a self-directed IRA to invest, when you withdraw the fund, the entire withdraw, sorry, I lost it. The entire withdrawal includes the principal and all return on the investments, and will they be taxed on it?
That is correct. So principal and gains are taxed as ordinary income upon distribution from the IRA. Now, distributions can start at age 59 and a half and are forced out at age 73. So you don't have to take the full balance. You could take portions over time to limit your tax burden. You also have the opportunity to convert the traditional IRA to a Roth IRA through a backdoor method and never pay any taxes on the gains.
Hold on 1 second. I'm not gonna let you off the hook that easy. What are you talking about? I want to hear more about it. So I come in, I'm 40 years old. I'm not, but I'm just saying as an example, I'm 40 years old and I'm planning to invest for the next 20 years. And you're saying there's two ways about it. One of them is you're forced, right? So the government tells you at the age of 73, your retirement have to be out of its little bunker, right? It has to be in your bank account.
Correct.
So we can get our cut. We've been waiting for you for way too long. Pay up, buddy. But tell me about the back door.
Sure. A backdoor Roth is simply converting traditional money to Roth money. You pay taxes up front on that conversion, and then all future gains are tax-free. So if you're young, just starting out, and you have a, we'll just random number, a $15,000 traditional IRA, you convert that to a Roth IRA, you're paying taxes on that conversion. And then over the next 40 years, you grow that 15,000 to say 7 million. You're never paying a penny in taxes ever again.
Okay, that's a nice growth from 50,000 to $7 million.
Would be nice.
Am I unmuted now?
Yes, you are.
Tony, this is Mark. I just want to ask you to make sure I'm thinking about this correctly. So if you use an ordinary self-directed IRA, whenever you withdraw from that, everything's taxed at your ordinary income rate.
Correct.
So if the investments in it are generating returns that would be taxed ordinarily at ordinary income rate, that's a wash. If you put into your IRA an investment that would be generating capital gains, not generating ordinary income, do you actually lose the benefit of that by using an IRA for that? Because you're going to get taxed on those gains eventually at your ordinary income rate. Do you lose? In other words, should you not use this vehicle if the investments in it will actually be generating investments that would otherwise give you the benefit of the capital gains rate? That makes sense.
With a capital gains rate, I'm in no way a CPA, so forgive the ignorance on the tax rates. Capital gains rates higher or lower than ordinary income?
Lower. It's only 20%.
Yeah,
and if you're in a 40
versus,
if you're in a 40% tax bracket.
So it makes sense to put it into this kind of a vehicle, investments that would be generating ordinary income as opposed to ones that would generate long-term capital gains. I just want to make sure I'm thinking about it right. It sounds that way.
Yes, I understood it exactly the same way, right? I understood exactly the same way. So remember we had the discussion, to bring it up as an example, we had the discussion, actually, Mark and I, and we spoke about why not put certain investments. We always recommend go through an IRA, and usually those are almost exclusively condo projects, right? Because in condo projects, we pay ordinary incomes on the gains. And so while we, as here comes the commercial, while we as Astor know that we are looking for condo projects, we want to see significantly higher returns than, let's say, other projects that will be taxed at a lower bracket. And so a condo project comes in, and we have multiple examples where we're able to generate fantastic returns, just fantastic returns. But when essentially we do the distributions, our investors are get hit with so much tax, okay, because it's ordinary income. And so I always recommend them, if you're investing in a condo project with us, I highly recommend it. Sometimes I say people don't invest in a project unless you're doing it through an IRA, because the impact is going to be too big, right? I'll give you an example. Some of our projects were generating as much as 30% a year. But once a condo project, but once we give the money to the investors, at the end of the day, if they're in a 40% bracket, right, there's almost a, it's not dollar for dollar, but there's almost, 40% of it goes away. So you end up around 18. And my argument is, if you're investing in a project and generating an 18, might as well take much lower risk. And so Mark is raising a very good point. Maybe not every project, well, I'm going to say the word maybe, not every project ought to be going through an IRA. Sorry, Tony. Only
I would cut
projects
you off
where-
there. I would say maybe not every project should be in a traditional IRA.
Should be in the
Because when the
traditional.
Roth comes into play, you're not paying anything. So the Roth
Because-
is the benefit.
But the rough you paid along the way. So kind of like, where's the impact? What's the benefit?
Well, you're paying the Roth up front. So that Roth should be funded. That money's already been taxed. You're taking 300,000 per year example. That
Right.
300 goes to the 2 million. There's no taxation on that. You already paid
Yes.
the tax on the 3.
I see. So essentially what you're saying, okay, that's very interesting. The rabbit hole is getting deeper here. So we're saying the 300,000 is post-tax, right? You've already paid your dues.
Correct.
Now drop it. So basically put it straight into the IRA, but do it as a Roth. Now let the money grow.
Correct.
And going back to our initial example, you took the 300,000, you were disciplined enough to continue investing, and you had an amazing manager who was very consistent, and you were able to generate a lot of returns. When you take it out at the age of 65, and in between 65 and 73, you're tax-free, right? That's interesting. I love this stuff. I mean, I always learn. We definitely are a big fan of Tony's company and Adam's company. And we always learn how to do it the right way, right? How to think about things the right way.
Well, the nice thing, Joe, is there are alternatives. There are alternatives to the Roths and traditional. So, and that's kind of
you
what
are
I do.
the ultimate alternative, right?
Yes. So imagine having a trust structure that, in essence, you can hold any after-tax asset, grows
Mhm.
completely tax deferred,
Mhm.
and then you can actually live your lifestyle out of the trust with pre-tax money, right? So tax advantage money that has grown in a tax deferred fashion, completely flexible to invest in anything you want, and then many other benefits above and beyond. So you have estate benefits of eliminating estate tax upon death. So it's a great
Mhm.
wealth transfer tool.
Mhm.
Complete confidentiality and anonymity built into the trust structure itself. So people don't know how much money you have, which is a benefit that a lot of people love, right? There's other benefits too, is asset protection. So imagine if you get in a car accident and there's a lawsuit because of it, and they find out you're a doctor, or they find out you're a business owner, or hey, Joe owns Astor and he has X amount of billion under management. I'm going to go sue Joe, right?
Mhm.
Well, if Joe has all of his assets protected inside of the trust, they're not going to get their hands on it, right? So asset protection, wealth transfer, eliminating estate tax, obviously tax mitigation. And then when it comes to how is the trust taxed, whoever receives the money out of the trust is going to pay ordinary income tax. So it's similar to an IRA treatment, but
Mhm.
the unique part about the trust is, with best practices and with my help educating on how to use the trust to its best potential,
Mhm.
most of the time who's receiving it and paying the tax is not you as the beneficiary.
Mhm.
It's the auto dealership when you buy a vehicle, or if you buy a yacht or whatever you're spending money on.
Mhm.
Those people are actually paying tax
Okay.
at whatever tax rates that income is producing for their entity or themselves.
Mhm.
So it's just another way to do it. And moving assets in, or even other private placement investments into the trust, is a pretty easy process.
Mhm.
Just some simple asset conveyance documents, basically selling assets into the trust and then retitling the name of that particular investment into the name of the trust. So it's a pretty easy process. And then you start getting the tax advantages immediately as soon as that is
Yeah.
done.
You're basically creating a separate entity, separate from you. And you say, that's not my money anymore. This is not my house. This is not my car. This is not my business. The shares of my business go into this new entity, right? And the new entity now controls all of it. And now it's insulated from lawsuits, insulated from taxes. I don't know what else, right? But those are the two major ones. And so what do I do with all of this great structure? Now, where's my money? I go to the bank. I was like, I have just a little bit left. So you're saying basically the trust now takes care of me. And how's that working?
Right. I mean, the trust really is modeled after the Rockefeller principle, which is own nothing but control everything. Right.
Mm.
So some of the largest family wealth on the planet has been created with these type of structures. These type of trusts have been around since the 1800. Standard Oil Trust, I think, was 1886 when that started for the Rockefellers. So when you want to spend money or live lifestyle expenses, any of those expenses are just a non-taxable trust expense. Majority of expenses in your entire life. So it could be healthcare, it could be your mortgages, it could be car notes, all your standard utility type bills. All of that can be paid directly out of the trust. So it's a little different, right? It's a little different type of structure. It is more costly to put that type of planning in place. Typically, a client that will have $50,000 in tax or more, that's when you start looking at this more advanced type of tax planning. But if you're not quite there yet, that's fine. Then you talk with Tony and you start investing more wisely with the IRAs, either the traditional or Roth.
Right.
I typically say if you have a Roth, invest in a self-directed Roth. If my type of planning isn't quite yet a fit for
Yeah.
that particular client.
Yeah, I mean, this obviously, it's for different level of investors, and certainly have high net worth, ultra high net worth, and investors that are certainly just getting into it. Everyone's accredited, so everyone's sort of like in the right mind space and financial stature to really get benefits from this conversation. I want to ask you, when the trust pays me, if I'm the beneficiary of the trust pays me because I want to take a vacation. When I pull the money out, is that capital subject to taxes of any kind?
I mean, so yeah, that's a good scenario. There's really no reason to pull money out and actually distribute it to the beneficiary. So, okay, you're going on a vacation. The
Mm-hmm.
best practice would be,
Mm-hmm.
right? Go to Italy,
Mm-hmm.
$20,000 beautiful vacation with your family, loved ones,
Yeah.
whatever.
Mm-hmm.
While you're there, pick up a few real estate brochures of
Mm-hmm.
properties that you looked at as potential investments and bring those back. And
Mm-hmm.
we'll keep that in QuickBooks, books and records. Now that travel was a non-taxable expense of the trust, versus if you distributed 20,000 to yourself as a beneficiary and then paid for the travel, that's a
Mm-hmm.
taxable expense at ordinary income.
Got it. So you
So
can pass some of the expenses back to the trust. Tony, I see
exactly,
Tony
it's
smiling. He's like, Tony's
it,
smiling. He's like, I should do. I went to Italy. I should have collected some brochures. Okay.
exactly, it's similar to how people run their LLCs, S corps, and C corps. You
it's a
have to be
private
very detailed
organization.
in your books and records
Right.
to justify what the expense was and categorize it in the right way in case there ever was an audit. Then you have a documentation of what that specific expense was. And I would say that 95 to 98% of your entire lifestyle expenses can be made out of the trust as a non-taxable distribution. So very few line items end up being actual taxable distributions to the beneficiaries.
Wonderful, wonderful.
So,
It's a fantastic structure.
Adam, what do you recommend for your clients that are not at the 50K or a higher taxable liability bracket?
Yeah, so there's
Besides that, we went into
yeah,
working with Tony, but what are some of the other things?
the middle of the road, right? So you have
Yeah.
kind of that Cadillac top tier,
Right.
this is family office, estate planning structures
Right.
with our trusts, and my unique type of trust specifically are some of the most powerful in the nation. And then you have anybody has access to IRAs. That's great. So we have two ends of the spectrum, and then right in the middle, I would say the LLC investment. So investing it out of an LLC. And why is that important? There are other tax strategies that I can implement on an annual basis to offset capital gains or other, income tax at the LLC level, because there's not limitations on basically your AGI, adjusted gross income, at the LLC level versus the personal tax return level. So with that said, just as an example, you invest in one of Astor's offerings, and it generates a certain return. And maybe you came in as a bigger investor. So you might have put $1 million in with them, and you said, look, I'm going to do that out of an LLC. If there is significant gains and it's one of their dividend type paying, preferred offerings, on an annual basis, we could actually look at it and see if there's a solution that we could offset that gain at the LLC level. And I have 20 or 30 different strategies. They're all different and unique, that can be better applied to an LLC versus a personal return. We can attempt to do that at the personal level as well. So if you do invest personally, it's not like you have to pay tax no matter what, because there may be a few of the solutions that could be applied to a personal tax return. But I would say that just from the scope of the conversation today, you have trust estate planning structures, then you would have LLCs, then you would have IRAs, right? And then it would be the personal investing as a individual. That's kind of the flow of everything that we've been talking about today as far as efficiencies from a tax perspective.
Adam, based on that, can you go into a little bit more about what is an LLC strategy? How can investors benefit when they invest via an LLC over a personal investment, shall we say?
Yeah, so a lot of what I do is what's called like a K1 loss strategy. It's actually an investment into a partnership using partnership tax codes and tax laws. And in essence, you invest into a business, and the way the operating agreements are structured in there, the new participants in the partnership are allocated the losses in that partnership, and then the gains would come later on. So they're getting initial K1 losses year 1, year 2, and then get gains eventually with some of those strategies. And that's just, there's many different types of that type of structure. There's also tax credits that can be purchased. There's other things like 181 deductions, which is investment in movie and tax credits. So there's a lot of different things that I do from a kind of a high level tax planner that has access to the strategies that a lot of CPAs don't really offer, because they're more tax preparers. To get access to these type of solutions, you actually need a tax planner or a CPA that is well versed in these type of solutions, because it's definitely an expertise that not it's not like a general practitioner that you go to as a doctor. It would be more like a brain surgeon, right? Somebody that's specialized.
I
I
think
see that Paul Matamoros has his hand up. Paul, you have a question?
Yes, thank you, Joe, and always enjoy your webinars when I could get on. This question probably might be directed to either Tony or Adam or even you, Joe, but I have a couple of questions. One, say if you inherit some money or you have some people that have some inheritance, would you recommend putting it into one of these vehicles before they venture into, say, investing into something like one of your offerings, Joe? That's one question. I understand that you guys aren't CPAs and everyone has to talk to their CPAs. I understand that, but in general, we're generally speaking. And then also too, how do you view the multifamily space versus the condo? I think I've given you enough to think about, but in these times.
who's gonna go first? Adam, Tony?
I'm sorry, I was mute.
Oh.
Who would you like to take this?
Well, I'm easy. When it comes to inherited, unless it's an inherited IRA, there's not much you can do on the IRA spot. You're just making a simple contribution to an account. So if you're getting a lump sum inheritance, it's probably best either for Adam or Director Joe.
Yeah, so I've dealt with this quite a bit. When there is an inheritance, hopefully, I mean, this is something that you can pre-plan. Hopefully, the family that has enough wealth to pass on has done a little bit of estate planning. And what I always say is if there's a certain dollar amount that makes sense, set a trust up, and instead of having the inheritance go to the individual, have the inheritance go into the trust. It goes into the trust corpus, completely tax deferred, and then you can grow those assets from there. One of the major differences from like generational wealth planning using trusts and just asset transfer vehicles, IRAs have some rules that Tony can go into, but when you get an inherited IRA, you're basically forced to take the money out in a certain time frame. Whereas if you get an inheritance into the trust, there's no rules. I mean, that money can sit in there. You can invest in what you want, you can grow it, and you can just add it to the family legacy. So grandkids, and so on can generate legacy wealth and also benefit as beneficiaries as long as the trust is maintained and keeps growing the assets, so it can survive for generations, just like the Rockefellers Trust has been around for almost 200 years.
So basically, the key element here is you're about to get an inheritance. If it's of a certain size, create the trust now, right? As a living trust, is that called a living trust?
So it's just the same type of trust I've been talking about. Ours is irrevocable. It's common law. There's like 7 different provisions with it. So you would set it up, and then the inheritance would actually go. So whatever the estate plan, it might be in place for whoever. Instead of having an individual as a beneficiary of the estate, the trust would be the beneficiary of the estate. So the money lands in the trust. It does not land in the person's hand because that's constructive receipt. There's a taxable event. Unless it would be an IRA, then they can do an inherited IRA, right? But it has to already be in that IRA structure.
Okay. Tony, I want to hear your thoughts. Inherited IRA, can you open up on that a little bit?
Sure. Adam's correct. The structure already has to be an IRA. Someone passes away, they can leave it to their beneficiaries, and then there are rules. So versus spousal, non-spousal IRAs, they also have a 10-year distribution window. So within 10 years of inheriting that IRA, it has to be fully distributed. So if you have a parent leaving a retirement account to a child, significant dollars, they're going to distribute that over a 10-year period. That actually can wind up become burdensome for that child. Whereas the spousal IRA, it can be put directly into the spouse's name, and then you pick up your normal RMD structures. But when people are really getting lump sum inheritance, very rarely do they go the IRA route, from my experience. But in our business, we see inherited IRAs every day. Unfortunately, it's part of life. People pass away. Self-directed IRA account holders typically are the older generations. They built up wealth over years, so it's something that we deal with multiple times a day, every day. And a lot of them, do get the distributed quickly, or they might just take that lump distribution hit at once. If you have a 19 or a 20-year-old acquiring a 6-7 figure IRA, they want the money right then and there. Bad planning on their part, but they don't care about the penalty or the taxes. They just want that cash, and they're cashing that out. So inherited IRAs, not really the best structure for lump sums, but it's something that we do handle.
Paul, you had some question about condos versus other investments. Was that directed to us?
Yes, Joe, I wanted to ask, how do you view the multifamily versus the condo space these days? With so much with the tax situation, tariffs, materials. Yes.
So, I'm going to break down the question a little bit, because how do we view it how do we view it in Brooklyn, New York, in certain neighborhoods? Fire, complete on fire. Demand is very strong. Prices are, topping off on and breaking, almost on a quarterly basis. There's a new project that sort of like breaks a new record. That is not the same elsewhere, right? The Queens is very different, and Long Island might be slow, and so it's a really question specific. So it's hard for me to say, condo market where. Florida condo market is very soft right now, and when I say soft compared to what? The condo market over here has gone through the roof and also broke records. We have untold amount of individuals that have placed deposits and are waiting to buy, and by the time they waited, prices have gone up, and now they've actually created tons of equity on a piece of paper. We haven't even seen their own condominiums. They could sell it today and make profits, and yet at the same time, condo market, housing market in South Florida is a market that we love. Has been going fairly slow, right? I mean, transactions have dropped from the peak of 2021 to the sum of about 50%. And while prices have not quite reflected it, but we are seeing a little bit of a price break of around, 5%, 6%, 7%. But then again, we're talking about all condos, right? So when we show up with a project, specifically condo, this was my point in my discussion with Mark Sirota. It was really fantastic, and we love to kind of like ping pong with him about about certain stuff like that. We had a discussion to say, what's the point of putting the capital? I might as well just pay taxes. And my argument was, when we already, it takes a while for us to say yes to a condo project, right? It's a different level of risk, I consider it. And there's certain condo project we'll probably never touch, right? The super uber luxury, like it's not for us, not our personalities, and it's a very different dynamic. But the ones that we did do, and we've probably done over 800 condo units, in the course of the last 10 years. What am I saying? Probably over 1,000 over the last 10 years, and multiple projects in multiple places. When we do that, it's because we see something, right? We see the kind of return that we feel is worthy of the risk that's okay to take, right? The risk reward type of a scenario. But here comes the second question: is what's going to be the impact? How much am I going to get in terms of taxes, or what's my post-tax? And so, my stance was, specifically with Mark, and I'm sorry to bring you up, Mark, multiple times, but my stance was on that conversation was keep it in an IRA, and I've asked multiple of our investors, when you bring capital to this project, bring it through a structure, create a structure for yourself. Okay. So if you want to do something quick, you have Tony and you have others, you can do an IRA. If you want to do something a little bit more structured, you have Adam, it'll put you. It's a shame, right? We are showing very, very substantial returns on some of those projects. Some of them have really hit the ball out of the park. Those of you that are with us on Avenue U in Brooklyn, you know what I'm talking about. You see the reports. But whether you're in the First Avenue, Second Avenue, other locations, the market, has really taken off in some of those locations and really did well. And all I'm saying is I think it's a shame to make such a beautiful return and to have it chopped down by 35%, 40%, some of those even higher than 40% because you pay ordinary income. When you sell condominiums, you essentially are selling not a chattel, but you're selling inventory. And when you sell it's under the IRS code, you're selling inventory unit by unit by unit, as opposed to when we're building an apartment building, we sell it as one unit, it's long-term capital gain, so you tax it to the lowest possible bracket. And that's where we come into those conversations. You'll see other things with us, for example, the structure that we do with the preferred equity, right? A lot of conversations go into it. Those of you that have participated with us in the preferred equity have noticed that we've arranged, even though you're getting distributions, we've arranged by language and by structure and by legal structure that that you're going to get taxed at capital gain, right? So how do you get taxed at capital gains is sort of like part of the tax structure that we've created. You basically only get gains at the very back end until such time we only return your principal. And we do look into those structures, and we look for not just great real estate, great partnerships, but we also want to make sure that you're able to retain a good chunk of it. So I hope that answers your question.
Yes, thank you. I could go on and on. It's very interesting. So thank you, Joe. I really appreciate
All of us, we're very passionate about what we do.
Thank you.
We're very passionate about it. It's just, it's fun. We're sort of like running into, we're past the hour. Maybe we'll open it up to a couple more questions, guys. And I want to make sure that people know how to reach you, Tony, and how to reach you, Adam. If they have questions, if they want to refer people to you, they want to meet with you, all that good stuff. Okay,
We
I can only
we
say
also
good things
have
about those individuals.
we also have their information, Adam and Tony's, in the chat with all their
Okay.
contact information. And of course, we'll be sending an email out to everyone with their contact information as well.
I guess there is one other very significant structure, or one other structure that you can invest in private placements, and that's actually private placement life insurance. It's a life insurance policy, but it's structured in a way that it can hold basically any asset that my trusts can hold. The biggest difference, and instead of tax deferred treatment, that's actually tax-free treatment. So how do you access your money out of an insurance policy is through a tax-free loan. So that's one of the other ways. And it's exactly what the product is called, private placement life insurance. You can hold private placements, crypto, real estate assets. So either active real estate assets that you're managing yourself, or passive, like Joe and Marika offer in their offerings. So it's another structure that's tax-free wealth building. I typically have our trust own an insurance policy. So now you have tax-deferred growth, tax-free growth, all in the estate plan. But I think that gives everybody kind of the list. The short list is trust and estate planning, private placement life policies, LLCs, IRAs. So that's just a good summary of what we talked about today.
Private placement life policies, are they simpler? They're very simple to do. They're kind of like 1, 2, 3 type of a scenario.
Same type of process. You go through the same type of underwriting and health screen process. It's just a different type of policy with different carriers. And then the design, which is very interesting, typically the design has lower cost and fees overall. So you're creating cash value a lot faster than other traditional mutual fund type policies or index policies. So imagine most mutual policies or index policies, you might make 3% growth to maybe 5%. And insurance salespeople will sell you that it's a lot higher than that, or the potential's higher. On average, the policies that I see are growing at a very slow rate. When you go to private placement, and now you have a pool of investments that are growing at 20, your tax-free wealth is growing at 20%. It's whatever investment portfolio you're building inside of the policy. So there is no perfect insurance policy. The downfall to that product is the minimum to participate. You need to put about $2 million minimum in premiums over like a 4 or 5 year period. So that would be the only downfall is, it takes roughly $400,000 of contributions over
Yeah.
a 5-year period, like 400,000 a year to participate in that policy.
Yeah.
I'm sorry,
Um,
Adam. I'm sorry to interrupt. Would that fall under the family banking umbrella, what used to be?
So yeah, become your own bank and infinite banking, all those principles.
Yes.
Any insurance policy that has cash value and also has a tax-free loan provision can be applied to those principles. And there's many, many books out there. Become your own bank, leveraging insurance to take out tax-free wealth, right, through the loan and then invest it. I just think that the private placement life policy is the best contract because all policies are contracts. It's the best contract and vehicle to really pursue infinite banking and become your own bank.
Thank you, gentlemen. Thank
Is
you.
there, Adam, so
Thank you,
in the
Paul.
private placement, are you able to choose where you invest?
So there's a fiduciary advisor on the policy, which is typically me, right? Because I'm helping set it up. And then I have to make all the investment choices. But I communicate with the client or life insured, whoever's the owner of the policy, and we have discussions on, what they're interested in. And then I make decisions from there. So if they like private placements, that's great. I've been able to do policies where I've had different income producing investments. I've had you guys, I've had it in private placement policies that invested, I think, $1 million in one of your projects, right? So it's a really great place to invest in offerings like you guys have. It's tax-free growth. And then once they want to get access to that money, they can pull it out on the loan, use it, pay it back, and invest, and then just keep investing that cash value as it grows. So it's just another way, and another thing that I thought would be, um, a good topic to bring up on this call.
Yeah, it's a great topic. But I guess part of it is, having the confinement, there's some cases, obviously, if you have somebody that can help you and you can influence each other, I'm not quite sure how much is that is allowed or not. But ultimately, if you're able to put money into that type of a life policy and you're able to get it to where you want it to go, then yeah, there's actually a lot of merit in what you just said. Maybe final words, Tony, from you, and before we sum up, we're sort of like running about 10 minutes over time.
Sure. I just thank you for having me. Thank you for the audience for joining us. Our contact information is in the chat, and I'm happy to speak to anyone at any time about self-direction and diversifying your retirement.
Yeah,
Thank you again for having me.
I want to say that I have two IRAs that I invest into, right? I want to say that working with Tony is such a pleasure. He's available. I always get the same guy, right? Entrust is a huge company. It's a $4
Yes.
billion company and growing. And when I call the other firm, which I'm not gonna, and I love them too, because I love them for a couple of
Do it.
reasons. Oh, guys, screw those guys. I love them because they do send a lot of folks our way, and they have a forest of investment managers to choose from. And I've been noticing more and more how many individuals they refer back to us. It took a number of years for them to feel so
Yes.
warm and fuzzy, but they've been very great. But I have to admit that push comes to shove. I make a phone call over there. I wait a day. I get a person. I get a different person the next time, and a third person the fourth. It's just it's a forest of a company. With Tony is he knows my account, and it's not just because of me. It's how he operates. He knows my account. He'll call me back. He'll text me. He'll be available, and I'll always get him. And he knows my
Right.
shticks, and he knows my questions. And if there's something that's missing, he'll go and figure it out. He'll come back. And really, this is why I think I really enjoy working with the interest group. It's because of you.
I appreciate that.
Also, I think he's very, very unique because of his creativity and the experience. You can't just be creative without experience, right? That's just a disaster waiting to happen. And so, I think coming up with all sorts of structures helping out in situation, and sometimes saying, listen, it's not going to be accretive for you. You don't have enough necessary funds, but keep on building it, hopefully with Astor or whichever manager you choose. And let's talk in a couple of years' time. Let's talk when your exits come out and that sort of a scenario. And then they'll come up with some really great stuff. He's very personable. Same thing. Service is number one over here. And we wouldn't recommend somebody that doesn't fall into the same category, doesn't have a DNA that is similar to us. So I think, for the last several years, we're very happy to work with Adam. We refer them on multiple occasions. People are very happy. And, I can't wait to get to the point that we're actually structuring it with Adam. And I'm going to say we're not far off from it. We're not far off from it because Tony's company has given us, not because of them, of course, but, regulations given us only so much that we can do. So it's a little bit confined. So we'll continue in both structures. I hope that you enjoy this conversation. It is recorded, and so we'll share it with you. And if you have any questions, you have Tony, and then you have Adam's contact. Feel free to use them. I want to thank you both, gentlemen, for joining us. And as much as we talk, I always learn something new. And I hope it's been educational and fun for all of you as well. Thank you, Marika, for leading the conversation, and thank you everybody else for joining. Take care, everyone.
Thank you, guys.
You work hard for your money. It's time to make your money work just as hard for you.
You will have a secure future if you were to use Astor.
Hi, my name is Raquel El Khadif, and I'm a realtor with Broker Nation Real Estate in South Florida.
Hi, my name is Elena. I'm originally from New York, now currently living in Miami.
First and foremost, I was looking for my investors for institutional level investment. And the beauty of Astor is that an investor can come in with relatively a small amount of money and still be part of a big project with high returns.
Over the years, I've had many experiences with investing. I've learned so much, and approximately 5 years ago, I ran into a company, Astor, and found that they completed my investment approach. They are so selective with their projects.
The returns that they project are always high, but the track record is even higher than that. So it's kind of an element of under-promising and over-delivering, which I liked, of course.
Just based on years of trial and error and other companies that I've invested with, that they are far superior to all the other options that I've tried.
And it gives me and the investors some peace of mind.
I like that with Astor, I can sit back and have my money working for me.
They attract seasoned developers.
Feel very safe and secure with my investments with them.
I fell in love with them.
And I only use them now for my investments.
You guys made us feel like we're part of the family, and I thank you for that.